Hello and welcome to Ticker Tapes. Today, we're back in the world of ETFs. No matter how hard we try, it's almost impossible not to talk about energy when we discuss ETFs in 2022. Energy-related ETFs have been among the best investments across any market segment this year. For example, UNL, the U.S. 12-month natural gas ETF, has risen by 97.94% year-to-date, whilst its stablemate, UNG, the U.S. natural gas ETF, has returned 115.85% thus far in 2022. What's more, neither of these funds look overbought on the relative strength index, and with the cooler winter weather just a few months away, who's to say that we won't see further gains if global gas supplies tighten amongst intense demand for a scarce resource in Europe and Asia. Corporate bonds and smaller companies seem to be in favor this week, with the Vanguard Short-Term Corporate Bond ETF, VCSH, gathering just over $2 billion of new money, whilst a $1 billion of new cash went into IWM, the iShares Russell 2000 ETF. Another $2 billion was invested in large-cap equity funds last week, and this was roughly split 50-50 between VOO, the Vanguard S&P 500 ETF, and IVV, the iShares S&P 500 ETF. The investment comes after a Q2 earnings round that was far better than many analysts had anticipated. Following the very strong run seen in technology and growth stocks over the last month, it's perhaps no surprise that money was allocated to the sector, with $549 million being pumped into XLK, the technology select sector SPDR fund. What's perhaps more surprising to us is the amount of money that's been withdrawn from dividend-oriented ETFs over the last week. Dividend investing is seen as a way to combat the effects of inflation, which eats more of the spending power and value of money the longer it persists. Inflation is still with us, of course, but some in the market are looking out to 2023 and thinking that it may be normalizing by then. That might help to explain why $3.5 billion was collectively redeemed from SPYD, the S&P 500 High Dividend ETF, SDY, the S&P Dividend ETF, and SPHD, the Invesco S&P 500 Low Volatility Dividend ETF. Strategists at investment bank Liberum have written on so-called smart beta ETFs this week. Smart beta funds follow a set strategy or look to exploit specific characteristics amongst a sector or other group of stocks. They were designed to allow investors to capture hedge fund-like returns and build crash-resistant portfolios. However, as Liberum points out, there is an ongoing debate about just how effective some of these funds have been at replicating strategies and capturing the returns from them. The latest smart beta funds to test the market are iShares, which aim to exploit the fact that overnight returns in the S&P 500 are much larger than those seen during the day. This anomaly is well known on Wall Street, but this is the first time that anyone has set out to systematically capture these excess returns. The iShares 500 ETF will trade under the ticker NSPY and will invest in S&P 500 E-mini futures to try and capture this day-night effect. It will be interesting to see if they succeed and if the anomaly persists or is arbitraged away.